Good evening and welcome to the Money Show, your trusted destination for investor education, financial awareness and smart money decisions. In today's fast-changing world, managing money is no longer optional, it is essential. From rising expenses and changing lifestyles to market volatility and digital investing, every individual today faces one important question: how do I make my money work smarter for my future? And that is exactly what this show is here to help you understand. I'm Kavita Thapliyal, and today a very important topic that we are focusing on. For decades, Indian investors have been told one thing: higher returns come with higher risk. But what if there are investment options that offer returns of up to 7 to 12%, come with government backing, and are specifically designed to provide stability and regular income at a time when market volatility, inflation and economic uncertainty continue to worry retirees? Senior citizens are increasingly looking for investment avenues that can protect their savings while also generating dependable returns. From the senior citizen savings schemes and post office plans to RBI-backed bonds and other government-supported options, there are several instruments that combine safety with attractive yields. But which scheme truly delivers? What are the returns, lock-in periods, tax implications and risks involved? And most importantly, how can retirees build a portfolio that balances income, liquidity and peace of mind? In this special edition, we break down some of the top government-backed investment options available for senior citizens and explain how they can help secure financial independence during retirement. Because when it comes to retirement planning, protecting your capital is just as important as growing it. So, let's begin the show, and we are also joined by Ananth Rathi, our guest today, who will be helping all the retirees and seniors navigate this particular investment option. Hi, evening, and welcome to the show. Ananth, when senior citizens look at investment options today, what should be their first priority? Safety, regular income, liquidity, or returns?
I think there's a lot of emphasis on returns, but in my view, if one is smart enough, I think they can get a mix of all the three or the four items that you mentioned, which is safety, liquidity, a good amount of income, plus also inflation beating returns. If you could mix up many of the products that are available right now in the market, which are government backed, few are not government backed, but then give you decent amount of returns, I think, by properly adjusting the allocation in each of the asset classes that we should talk about, I think one can make the best out of all the three.
Right, sure. Let's just help our viewers. How can they do this, And let's just specifically start with government-backed schemes. Senior citizen savings schemes, Pradhan Mantri Vay Vandana Yojana, post office MIS, RBI bonds remain popular among retirees. Now, which of these currently offer the best balance between safety and returns, if one may need to understand and maybe start investing in it?
The first one definitely is senior citizen savings, right, which offers you about 8.2 to 8.4%. As I know, this quarter is about 8.2%, and they release quarterly payments at a regular interval. I think that is very high, and it also is backed by the government. So that is one of the best investment when it comes to government investments for senior citizens, followed by the Vayu Vandana Yojana, which gives you about 7.5%. Give or take a little bit here and there, roughly a pension amount, which will be guaranteed by the government themselves. So in my view, these are the two items that one can possibly look at giving a slightly larger allocation. The other thing that we can always look at is RBI's floating rate bonds, which means when the interest rates go up, maybe that's one of the options that one can use into lock-in. I think that's one of the items that a lot of people don't talk about. But in an increasing interest rate scenario, instead of locking in your money for a very long period, you could possibly use floating rates when the yields are low, so that when the yields go up, you possibly could add them and shift them into longer duration.
All right. So talking about floating rate bonds and other investment options that you just mentioned, what would be the tax implications?
In all the numbers that I mentioned, everything would be taxable at marginal rate. So one needs to be carefully choosing their regime, but also making sure that they don't have too many of the other rental or regular income kind of options that they have. If they do have, then this would be knocked off to that extent by taxes. But otherwise, in most cases, 30%, 20%, 10% is the tax rates. Whatever is your income tax rate, you will end up paying that much amount.
So in the current scenario, would you recommend a floating bond to a viewer, to a retiree?
I would definitely recommend in the interest rates, when the interest rates are lower, let's say, for example, if it was last year, 2025, and the interest rates were not really high, at that point in time, I would tell your viewers and tell my investors to be a little less allocated in long duration bonds and more allocated into bonds that are low on returns at this point in time, but can actually go up in the next 1 year or a couple of years. Primarily because if you lock in for a 30-year at a 6 quarter or 6.5% kind of an interest rate, then you're going to be impacted for the next 30 years. So you rather wait out for the next couple of years, put your money into floating rate bonds, and once the interest rates peak, let's say, for example, today it looks pretty attractive, let's say 7.5%, 8%, as I was mentioning earlier, then you should shift to that particular amount of money into a long-dated bond, again, backed by the government, so that you can actually ensure that your longer duration, 30 years, 20 years, is at least attractive enough and can beat inflation pre-tax at least.
What about fixed deposit? Because a lot of retirees simply put their money or their life savings in a fixed deposit. Is that the best option for them, or the ones that we are discussing, fixed deposit can be the second or the third choice?
I think it's definitely one of the choices that one should have, because when it comes to debt, it's always better to look at liquidity as one of the serious concerns that one need to look for. Because many of the bonds that we are all looking for, which is backed by the government, have 5-year lock-in. You'll end up paying penalty if you actually exit in about 3 years, which could possibly be negated by keeping some of the money, especially the emergency money or some corpus that you may need in the next couple of years in a senior citizen FD. So you can allocate a certain portion of your money in a senior citizen FD, which will give you the liquidity requirement. Of course, the interest rates are not going to be as high as a senior savings bond, but that is okay because you're looking at liquidity more than the return. So I would say if I were to design for someone, maybe about 10, 12, 15% of the money can always get into an FD. But as much as possible, because we are talking about longer retired life, we should look at more and more long duration first.
All right, but then, let's also talk about inflation. We are talking about putting the money where they can have consistent income, and there is low risk also. But we're also dealing with an inflation situation. Okay, currently it remains a major concern. And for retirees, how can they ensure their savings continue to generate real return after accounting for inflation? How can that be strategized? I mean, just to take the current scenario, we have the policy by the end of this week. I mean, we really need to be careful on the tone that might just be given by the governor. But having said that, worldwide inflation is something that's looking at the economy's face. And for retirees, where they have limited earning options, they have limited income options, a part of their investment corpus needs to be generating some inflation-beating return. Is that right?
You're perfectly right on that, Kavita, and I'm glad you brought this up, because one of the risks that senior citizens need to look at very clearly is the longevity risk, which means that the life expectancy is on the rise. So you will have to go through multiple years of inflation. And unfortunately, when you start withdrawing your money from an FD or a bond, as we were talking earlier, the inflation factor will come and hit you very hard, especially in the next 5, 7, 10 years or so. So, for example, if the inflation is 4%, and you make about 7%, you're still going to make a real return pre-tax only at about 3% or so. So, for us to make sure that the portfolio is looking at inflation in a slightly different way, I would not shy away from allocating about 15 to 20% of the money, which is a long-term money in equity. Again, it doesn't mean that we go in pure equity fund. We can definitely use options that are in the category called hybrid, which will invest some part of their money in equity, which will at least help us to protect a bit of our money on the inflation side. Otherwise, what could well happen is that inflation will eat away a large part of our corpus, what you have today will not be enough for the next couple of decades. And we will end up staring at a very bleak future after maybe once you hit a 70 or 75 age. That's why a small portion of the money, maybe 15%, maybe 20%, could always get into a hybrid fund as a category, which will help us to beat some part of the inflation.
Every business is like a piece of land.
How important it becomes for senior citizens to also be mindful about the tax that will be levied on their investment instrument, because a lot of time, see, till the time you are earning, you want return generating avenues. But once you're retired, you really need to factor in the risk part of your investment instrument. But equally important is the tax outgo. How can one be mindful over here and strategize it carefully?
See, one of the things that we at least look for, there are these days, one of the categories that people are ignoring, but it's a good category of investment is called REIT, which is Real Estate Investment Trust, where you go and buy units of real estate to oversimplify things. There, possibly, when you look at various REITs that are available at this market, you can possibly look at designing in such a way that the money that comes to you on a regular income basis, some part of it is it will be called as a capital repayment, and some part will be called interest. So while you still continue to enjoy a sizable portion of your money in the form of regular income, because it's a 50%, let's say, is a capital repayment, and the 50% is interest, your interest component or the tax component comes down in one of the ways. Right? You could reduce your tax component by going for these kind of investment items that can possibly reduce some bit of taxes. The other thing one needs to be very watchful of is, try and invest in, let's say, government-backed PSU bonds, which offer some bit of a tax-free advantage if that is available. These days, there are not many of them that are coming through. But if there is an availability that comes through, I think one should latch onto that. And this third and something which will clearly work out is, you need to go into items that will give you more and more long-term capital gain tax benefit, which is 12.5% at this point in time. So you would want to invest in a very, very low risk hybrid category and withdraw the money using systematic withdrawal plan. That will again let you incur a bit of taxes, but that will be only at about 12.5% versus your income tax being at about 30%. Let's assume that you're at the highest tax bracket. So these are 3-4 ways in which you could possibly reduce your overall tax outflow, but it is a very, very key important item that one needs to be looking at before making a complete attack.
Okay. What about dividend-paying stocks or equity mutual funds where they can earn dividends? Should this be considered?
I would not be okay with an option of investing with dividend-paying stocks, because while dividends do come through, one, dividends are going to be taxable at the highest tax bracket. That is one. And the other thing is you are going to invest into a bunch of stocks that may be declaring dividends but not going to be growing enough because most of the amount has gone back to you as dividend. Plus, you're also going to be subjected to equity risk. So I'm not in the same bus when it comes to investing in dividend-paying stocks. But yes, there are many hybrid category funds like a balance advantage fund or equity savings fund that have a determined track record, which says that we will pay you about 5.25%, 5.5%, or 6% kind of an annualized dividend payout for the next 20 years, 15 years, right? One can possibly look at those kind of mutual funds that will offer you a certain dividend track and invest a certain small amount of money there so that they can use a capital gain tax benefit, but definitely not in the dividend yield cap.
Okay. One question, for someone who's watching the show right now, maybe a 60-year-old retiree now, retirement corpus is almost of 1 CR. What could be a broad-based asset allocation framework, that you might want to recommend for them to also preserve their capital, generate returns? And I'm talking about a time span of almost 20 years.
Okay, so I would look at the portfolio into 3 ways, right? First is clearly capital preservation, because that is very, very important, because capital loss at this age will will be difficult to gain back. So that is one part. Second part is definitely going to be a slightly better inflation beating return. And third is definitely inflation beating returns or growth, right? So if I were to split it into three parts, the first one will be capital preservation, which will be government-backed bonds and various other schemes that the government has launched, where I would invest up to 40% of my money for a retiree. The second one being debt mutual funds. There are many types of debt mutual funds. You could possibly look at arbitrage funds. You could possibly look at corporate bond funds. You could also possibly look at dynamic bond funds and short-term bond funds. If you're okay with a little bit of a slightly higher return, but ignore the daily volatility that it comes with, I would say about 40% of the money going into the second category, which will help you to beat the inflation a little bit. And the third and the clear category is hybrid, where I will invest up to 20% of my money, primarily putting most of my money in equity savings fund as a category, or multiple SIFs that have come into the market at this point in time, and some part of the money into a balanced advantage fund with a dividend history. So this is how I would split 40%, 40%, and 20% in the ratio.
All right, I think so definitely we have a lot of other aspects to be discussed on this senior citizen special, but then we also have a few questions from our viewers, and I think let's just start focusing on that. Anand, we'll take Mr. Hari's question, and he's been investing since 30 years and now retired at 66. Equity investments in mutual funds have enabled him to meet his financial needs, be it his daughter's education, marriage, etc. Now that he and his wife, I think both are retired, and they want to grow their investment opportunities. And so the portfolio, both in equity, holding almost 100 stocks and ETF plus mutual fund portfolio without crossing LTCG limit of 1.25 lakhs and shifting to a more realistic investment in equity and mutual funds. He has a few SIPs running, approximately 60,000. Okay, so I don't have the exact details of his portfolio right now with me, but this is what he's planned for himself. How would you like him to navigate? I mean, I believe he's done a quick planning for him so far.
Yes, absolutely. I think he's used equity to his very well in his wealth creation journey, and congratulations to him on that. Like you mentioned, I think he's doing an SIP of about 60,000 rupees, and he's about 66 years old, and he's built a sizable corpus. But in my view, I would say, instead of putting money right now and in the form of an SIP and then again withdrawing from some other assets, I would rather convert that money and park it in more debt investments, so that you could use it as a part of your withdrawal strategy, maybe after a couple of quarters, maybe after a couple of months either, right? So I would ask him to not continue with his SIP, because it's like a cycle that he's doing. And the other thing that you had mentioned is about 100 stocks, which I think at this age and time, it's going to be very difficult for him to manage 100 stocks. I know he wants to withdraw that without incurring LTCG. So what I would do is he should look at it as about a 3-year plan. What he should do is, look at 100 stocks, see where there are quality stocks, keep those 15 stocks, and slowly the remaining 85 stocks, maybe about 25 stocks each year, he could possibly exit and look at a night having about 15 to 20 stocks, if at all he wants to manage them in his portfolio at the end of 3 years. So stop SIP, make sure that the portfolio doesn't have 15 to 20 stocks, and high grade, high quality stocks is what you should probably hold for the long term.
Sandipan from Mumbai, he's 57 years old, selected and parked 2.5 CR for the in the funds, started from 2029, which will be starting from 2029. ICICI Pro Equity and Debt, 50 lakh, HDFC Balance Advantage, SBI Balance Advantage. He also has DSP, Kotak and Multi-Asset. PPF, he has 50 lakhs. SIPs are also going on in the funds. SBI Contra, Kotak Mid Cap, Nippon Small Cap, PPF, HDFC Balance Advantage. He wants an advice on SWP, which will be starting from 2029, and withdrawal will be 1.25 lakhs per month against 2.5 CR, and that's going to be for 10 years.
So 1.25 on a 2.5 crores roughly works out to about 7.5%, which is, I think, pretty achievable, provided he makes sure that the withdrawal plan is correct. So, for example, you did mention that he has got a few set of balance advantage fund. I think it's a good strategy, but I think he's also replicating two funds. So one of the funds possibly could be merged. So for example, SBI could possibly be merged with HDFC Balance Advantage Fund. There's no point in having too many of them at this point in time. And I also see that he's got PPF, which is a little less on liquidity. I'm not saying it is poor, but it's a little less on liquidity. So he could use that corpus as a part of his emergency retirement corpus. And I also heard you say that he's doing an SIP in small caps and caps funds, which is definitely not recommended. I would rather do the stoppage of small cap and mid cap funds, and those amount of money I would rather park it in a BAF, which is a balance advantage fund or an equity savings fund. So this is how I would restructure his portfolio, so that when it comes to 2029, a sizable corpus of his will be in equity savings balance advantage category, and some bit of a debt could be also added at the end of that. But I would use PPF more as an emergency fund or an emergency corpus at the end.
All right, let's move on. Let's take Sunil Kumar's question. He's from Vadodara, Gujarat, and he's got a couple of funds. SBI large cap, Axis small cap. He's got Kotak multi cap, HDFC mid cap, Mirae Asset large and mid cap. 18 lakh is already in different mutual fund at this time, and he wants to change his portfolio. Needs 10 lakhs in 2033 for his son's education. 50 lakhs by 2038. That's the retirement goal. Okay. So 10 lakhs by 2033 for his son's education and 50 lakhs by 2030. I'm not sure about the retirement amount. He might just want to go back and, rework on it. But having said that, assuming that he's factored in everything for retirement that needs to be done, how can you help him?
So you said he does about 14,000 rupees broadly of SIP. So 14,000 rupees naturally will end up growing to about 56 lakh rupees with the 18 lakh rupees kind of a corpus that he has, even if he doesn't do an SIP. So I don't think there is a big worry, because this number itself will become a 56 lakh number by 2038. But definitely for his son's education, what he may want to do is split the SIP of 14,000 into two categories. The 4,000 could possibly get into something a little more safer, because the goal is not very far away. 2033 is about 6-7 years old. And let's say, by God forbid, if there's a big fall just when he needs the money, we shouldn't be left in the dark. So that's why I would say about 5,000 or 4,000 rupees of his SIP could be getting into slightly more hybrid, slightly more safer category of funds, while the remaining funds that you mentioned can continue with the same SIP pattern. That is one. I would also want to restructure his 18 lakh portfolio. Maybe about 3-4 lakhs of that 18 lakh portfolio could possibly get into a slightly more safer fund. Again, considering the fact that when he wants to withdraw, he would end up having some bit of, he shouldn't end up having some bit of a volatility portfolio. But I think if he does this couple of small restructuring, his retirement is not at risk. Definitely, he could also plan his son's education better in 2030.
All right, Ananth, I think with that, it's a wrap on the show. Thank you so much for being on the show, on this very special show that we get regularly for senior citizens, helping them understand the safest and the best investment option, and also answering the questions. Thank you so much for your time today. But in case you want any help, do send across your questions. You can scan the QR code that's flashing on the screen. You'll be connected to a WhatsApp number. Leave your queries there, and we will help you navigate all your investment strategies, align it with your financial goals. Thank you so much for watching. Goodbye.